Hey, it's Tim Kerley here with your Friday FAQ. Hope you are doing well and have had a great week and you're ready for a good weekend. So this week's topic, large deposits. And this is something that can come up and does come up very frequently and can cause a lot of problems. So that's one of the things we try to counsel with our borrowers is you don't want to be moving money around a lot or making any kind of large deposits that you cannot produce documentation to show where the money came from. Well, first of all, let's talk about why is this such a big deal, and then I'll talk about the guidelines with you. So there's really four reasons, and you know, all the agencies have rules around large deposits and the source of where the money came from, and that's really where the guidelines come from. But you know, there's really four reasons why there would be a concern about large deposits. Number one is if the buyer is using this money as a down payment, did they go and borrow the money? Which is, you know, unless it's a secured loan, in many cases is not allowed. But even if they did, if they borrowed the money, well, now they're going to have another monthly payment that has to be included in that debt ratio. So that's the first thing, is did they go borrow the money? The second thing is someone that is connected to this transaction giving them the money? And you know, that's obviously not allowed. Somebody that can benefit from the transaction, like the seller, cannot be giving them money that is not showing up on the closing disclosure. The third thing is, did they get a gift? Now, you know, in most cases, gift funds are fine, but, you know, side by side, getting gift money as opposed to saving the money yourself for your home purchase can be an underwriting factor. Let's think about it. I mean, if you've got two borrowers that are exactly the same, one of them has been saving their money for, you know, a year to be able to make this home purchase, and the other person, you know, maybe has $12 in their account and they got a gift. All things being equal, the underwriting systems are going to view the person who was able to save their money as a stronger borrower because they have some discretionary income there. So that's the third thing. And then the fourth thing is, if there are deposits into an account, could this signify an additional income source that the lender doesn't know about? Now, why is this a big deal? Well, you know, several of the programs have income caps on them. So if your income is higher than, you know, their stated cap, then you are not eligible for the program. So that's the fourth thing. That's the fourth reason why a lender would be looking at large deposits. So let me tell you about the guidelines, and they're pretty lenient. So on a conventional loan, if you have a deposit that is more than 50% of your gross monthly income that's on the application, then we're going to need to have some documentation on the source of that deposit to be able to use it as far as your funds to close. Okay, so if your application income is $5,000 and you have a deposit that's $2,600, that's going to have to be sourced. If it's $2,400, generally not going to have to be sourced. That's on a conventional. On FHA, it is 1% if you have a deposit that is in excess of 1% of the adjusted value of the property, which means the lower the purchase price or the appraised value. So, you know, if it's a $200,000 purchase and it appraises for $200,000, any deposit that's over $2,000 is going to have to be sourced. On USDA, all deposits that are not payroll deposits have to be sourced. And that goes back to the income thing that we were talking about there. USDA has that income limit, and they're just trying to make sure that there's not another income source out there that could possibly make that buyer borrower ineligible. And then VA is a little bit more lenient, and theirs is a little bit more murky. They don't seem to have hard guidelines about how much a large deposit can or cannot be. They really leave it up to underwriter discretion. But typically, you know, if it's a deposit that is in excess of one time of the gross monthly income, so back to our $5,000 a month example, you know, if you have a deposit that is in excess of that, then typically that is going to have to be sourced. Again, that's underwriter discretion, and depending on the circumstances, the VA underwriter might require something different than that. So, you know, once the money has been in the account for 60 days, in most cases, 60 days, it is considered seasoned, and there would not be any need to produce any kind of documentation showing where the money came from. Now, if there are large deposits, the buyer borrower can show or can produce documentation showing where the money came from. And as long as it's a legitimate source, then that is fine. If it's a cash deposit and the person cannot show proof of where the money came from, well, then they're going to need to write a letter and just tell the lender, where did this money come from? And if it's a cash deposit that cannot be sourced, it's going to be backed out of their total available for closing. So if they need that money for closing, that's where it gets a little bit tricky. So again, that's one of the reasons, and this is something that you want to know as well as you talk to your buyers. You want to make sure that they don't, not moving any money around and, not making any cash deposits. Or, I always talk to my clients, if they're a little ways out, if they've got a cash deposit, I tell them to go ahead and get that money into the bank and let it season so that will not come up later. Okay, hope that is helpful to you. Please feel free to reach out if you have any more questions. Have a great weekend, and we'll see you soon.